right, guys, welcome back to another video. We're going to talk about stock exchanges and stock indexes today. Now, a stock exchange, there are two major ones. The two biggest ones are the New York Stock Exchange and the NASDAQ Stock Exchange. So you might see those thrown around. You might see on the news when somebody's ringing the bell to close the market. That's typically at the NASDAQ Stock Exchange, right? Or when you see on the news, people walking around, a lot of computers and people walking around when they're talking about how the markets are performing. That's typically the New York Stock Exchange. It's an actual place, a physical place, and there are people there, market makers, that are taking orders for selling and buying stock and other securities. So when you see those, that's what those are. It's just the exchange. That's where stocks and other securities can be transferred. Okay, so when you go buy a stock on Fidelity, Fidelity goes to an exchange, and there's a lot besides those two, but those are the two biggest ones. They go to an exchange, talk to a market maker, and say, hey, we want to buy this stock, 100 shares of XYZ stock. They say, okay, they find a seller, and they pair the two together from wherever they are. Maybe they're at Charles Schwab, and they're selling through Schwab, and Schwab goes to the market maker and like, okay, hey, we can make a market for this. Yep, we'll sell 100 shares. So most of these companies, they have so many shares that it's, it all happens in an instant. Back in the day without the technology, it was a much longer process and much more difficult. But now it all happens instantaneously, but it all is routed through an exchange of some type. Okay, so let's talk about stock indexes, because this is something that everybody's heard about and few people really understand what in the world these are or what to do. So stock indexes, there are over 5,000 indexes. You've probably heard of the S&P 500, but there are over 5,000 indexes. So what is an index? In the industry insiders, analysts, financial institutions, they wanted a way to track the economic performance of certain types of companies, certain segments of the market. They want to do that in very fine detail. So essentially, they can decide on whatever niche they want to and kind of put together an index around that niche. And it's kind of a benchmark, right? Or an indicator of how the economy is growing for that niche or declining. So the largest ones, the three most common, right, that are always quoted on the news when you're watching CNN or whatever, MSNBC, you see the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. Those are the three most widely followed indexes that really track the broader economy overall. So if they say, oh, the Dow Jones was down 3% today or 3 points today, the S&P 500 was up to this level, right? It gives you an idea of, hey, in any given day, what direction are we moving? Are we going up or down or flat? So let's talk about what these are. The S&P 500 was created by Standard & Poor's, which is a rating agency, right? There's a financial institution that rates the quality of different securities. So what they did is they took the 500 largest companies in the US by market capitalization. We talked about that, by total shares, value of shares outstanding. And they take the largest 500 companies and they put them together in a basket. And what they do is they track it day to day and, second to second really, but they track it, and that aggregate of those 500 companies and their individual performance all goes into this aggregate. And you see performance over time, over a day, over a week, months, years, over decades. Now, some companies eventually fall out of this, right? Maybe they start to decline and they don't do as well and competitors beat them out and they kind of fall out and new companies are put in. So this index changes from time to time. Okay, it's not just as any company, right, will grow or decline. So they keep really the 500 largest companies in there. They have a few other measures or indicators for what they're looking for. So it's not just purely the top 500 by market cap, but generally speaking, it is. And they have a committee and they vote and they decide who is included. So Tesla last year, even though they had massive market capitalization, they were finally just barely included last year into the S&P 500, even though technically they were one of the largest 500 companies. So the committee wanted to see, hey, is Tesla actually the real deal? Are they going to stick around, or is this kind of a flash in the pan and the value is going to drop again? So they made the determination and they are now included in the S&P 500. Okay. So the S&P 500, the way that it's weighted is actually weighting by company. So the largest company makes up the performance of the S&P 500 is proportionate to the size of each company. The largest companies have the biggest influence on the overall performance of the S&P 500 index. So let's look at what some of those companies are, and we can kind of see what this looks like. So here are the different companies included, starting with the top, which is Apple, then Microsoft, Amazon, Alphabet, Tesla, Alphabet, Class C, different class of shares, NVIDIA, Berkshire Hathaway, Meta, United Healthcare, et cetera, et cetera. These are all all names we recognize. We're very familiar with these. What I want you to see is the weighting, okay? Apple is weighted 6.8, Microsoft 5.9, Amazon 3.7. These have a disproportionately larger weighting within the index, right? They make up a larger percentage of the index as compared to these companies down here, which are all under 1. And there's 500. So, I mean, the list goes on and on for a long time, but essentially that's how it's made up. So this accounts for roughly 75% of the total stock market capitalization. I mean, if we're talking broad market, that's the S&P 500. Roughly 75% of the overall value in the stock market is included in here because it's the 500 largest companies. And so this is a very common, you'll say, hey, just invest in the S&P 500, just invest in the index and you're good. Let's talk about these other ones really quickly. So the next one is the Dow Jones Industrial Average. This is one of the largest, or one of the oldest, I should say, indexes. And it's tracked 30 of the largest and most influential companies, okay? And companies can fall in and out of this. You know, there's a committee, they decide. But generally speaking, these companies are extremely well established, but they also offer dividends, okay? So when you hear, hey, blue chip stocks, okay, you'll hear that term tossed around. What does blue chip mean? Blue chip means that that company is paying dividends, and they might be paying consistent and high dividends, okay? Those are the types of companies that are generally included in the Dow Jones Industrial Average. So let's look at some of those. United Health Group, Goldman Sachs, Home Depot, Microsoft, McDonald's, Amgen, Caterpillar, Visa, Salesforce. Those are all included within the Dow Jones Industrial Average, okay? 30 companies is all. Now, this obviously makes up less of the stock market overall. It's roughly 25% of the overall value of the stock market, but it does show these types of companies, these blue chip companies. It shows performance, kind of tracks performance over time in among that group, okay? And then the NASDAQ Composite. So the NASDAQ Composite is all of the stocks that trade on the NASDAQ stock exchange. And traditionally, the NASDAQ stock exchange has leaned towards more speculative companies, and which has meant technology. So a lot of tech companies will list on the NASDAQ as opposed to the New York Stock Exchange because it's more focused around tech companies. So it leans towards tech stocks. So if we look here, we're going to see, just a ton of companies. This isn't by weighting. This is just by company name, okay, alphabetically. But you probably recognize some of these. 1-800-Flowers. Let's see here. I mean, there's just a ton of companies, obviously. Activision, Blizzard. So there's 3,738 companies that are listed on here. So that's the NASDAQ Composite, okay? Mainly, so when you think about tech stocks, think NASDAQ. It leans that direction. So those are the different indexes, the three major ones that track like the very broad market. But like I mentioned before, there are over 5,000 and they track different things. So you could go find an index that tracks small cap healthcare companies. Okay, so you could focus in by small cap and then so smaller capitalization companies, and then sort even further by an industry or sector like healthcare. And you could find an index that tracks companies, small cap healthcare companies, play in that space. You can basically cross divide and find any index you want. So these indexes are used, generally speaking, as a benchmark for how the market and the economy are doing, but also as a benchmark for other assets on other securities that you can purchase. Okay, so you cannot invest into an index. That is one thing that's important to know. The index is not an investment. The index is just basket that they track, a basket of companies that they track. That's it. So what happened is you have a lot of people that manage money actively, and they put together a portfolio like mutual funds. We'll talk about mutual funds in a minute, but they'll put together their own basket of investments, a portfolio, and they say, hey, I'm going to create a mutual fund. I, as the fund manager, I'm going to select all the companies that I want to be included in here, and I'm going to try and beat the market. When you hear them saying beat the market, it means beat the index, right? Beat the broad tracking benchmarks. So these fund managers want to outperform. So if they buy large cap stocks, right, generally speaking, they're going to be compared against the S&P 500, right? That's their benchmark. So if the S&P 500 returns 10% in any given year, people are going to look at the fund manager and say, hey, you're invested in large cap stocks. How did you do compared to the S&P 500, which is made up of large cap stocks? Did you do better or worse, right? Maybe they come back and they say, yeah, we got 15% 8%. So then people are like, okay, well, actually, yeah, I want to invest. You're a good manager. Okay, I want to invest in your mutual fund. Maybe they get 5%. People are like, yeah, no, you're not a good manager. The broad market beat you. You underperformed. And so, right, I'm out. I'm going to go pick another fund. So along the way, people started thinking, hey, instead of paying fees to a fund manager to have him pick these stocks and try and outperform the market, why don't we just invest in the broader market? And so index funds were born. Okay, it could be mutual funds or ETFs, which we'll talk about later. But essentially, Vanguard was like the pioneer of creating these index funds. Index funds you can invest in. You can invest in a fund that is based on a benchmark. So what they did is they said, okay, what we're going to do, instead of having a fund manager actively picking and selling stocks and like trying to outperform the market, what we're going to do is just have whatever's in the S&P 500. We're going to create a fund and we're going to buy the same companies and the same proportions and just throw it into a fund. And then people can buy into that. Okay. And we'll charge very little fees because we're not managing anything. We're just mirroring, copying exactly what the index is. So they copied it, create an S&P 500 index fund that mirrors the index. And then they've done this with a lot of the indexes out there. So you can go buy into a Dow Jones Industrial Average index fund, a fund that was created to mirror the index. Same with the NASDAQ Composite and all the rest. So there's a lot of different indexes and people have created funds that just essentially mirror them. No active management, lower fees because we're not actually doing anything. We're just literally copying the index. So we'll talk about active versus passive investing, but that is what the stock indexes are and why they're important, why they're tracked, why people pay attention to these. And so when you look at these major indexes, you really get a good idea of how the economy is going, not in any given day or week or month, but over time, you can get a gauge of how the economy is growing, if it's trending upward or trending downwards based on the long time performance. You know, if you look at the charts, they're like this, but you zoom out over the long term, you can get an idea of the trajectory. Okay, that's why these are important and how they're used within the industry. So we're going to wrap up this video here and we'll dive into more basics around the stock market coming up.
Your financial freedom journey continues here.